And welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. Stewart is President of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
I'm doing unbelievably well. How are you doing?
I am doing fantastic. It's always a pleasure to see you, and I love all the information that you share with the viewers at home because obviously you've been extremely busy. So how are you balancing all of this?
Yeah, it's tough. You know, I mean, the nice thing is we have some great advisors that work with us in our Tempe office, in our Scottsdale office, and of course the West Valley office, our original site there, where we serve some great communities there. A lot of our clients from Sun City Grand and Portobello have been great with us for years here, and since we expanded over the last couple years to Scottsdale, and of course where we're filming here in our Tempe office, we've done incredibly well, and it's I have some great help.
Yeah, absolutely. Well, teamwork is the dream work, right?
That's it.
Okay, well, I have some great questions for you today because obviously the topic of our show, Stewart, is going to be the current state of economy, Roth IRAs, and tax planning. So I just have to ask you right out of the gate, what are we seeing in the market right now?
Well, I've been talking about the same theme for, weeks on end here, but volatility is the key. We're seeing tons of movement up and down when it comes to the market. We've seen, the stock market up and down, where a lot of people historically have been very comfortable in 100% equity portfolios because they just basically saw it go up and up and up and up. And now what we're starting to see is those people that have those 100% equity portfolios that, are starting to get scared when they start to see a couple point drop now. They're rethinking this thing. Does it really make sense to be in such an aggressive position?
That makes sense. So I just have to ask you, obviously, let's talk a little bit more about Roth IRAs, if we could. That seems to be a hot topic right now.
Yeah, absolutely. It's, Roth IRAs, the first thing we should do is define what they are. When you put money into a regular IRA, for example, you get a tax deduction. When you put money into a 401k, same thing. You don't have to pay taxes on the money that you put away. And so that's been a big incentive. With a Roth, you don't get that tax deduction, but what you do get is to be able to put it away and take it out tax-free in the future. So as it grows over your lifetime here, all of those dividends, all the capital gains, all of those things that you would otherwise pay taxes on are tax-free in a Roth. And that has a cascade effect on all of your other income down the road.
Stewart, I also want to ask you a little bit about the Secure Act. Can we talk about that today? A lot of people are questioning what that is.
Yeah, so the Secure Act was actually, a bill that we actually had a little bit of input in. I don't want to overstate our importance in this, but we did fly back in December of 19 back to Washington, D.C. We had meetings with the staff of the new Senator Sinema here at the time. She had just beaten McSally for the senatorial seat, and she had a phenomenal staff. We had meetings with Debbie Lesko out of the West Valley, Dave Schweikert, who is an awesome guy, and then Andy Biggs out of Chandler there. And we were really pushing to get this done. We really wanted the Secure Act done because it added a ton of benefits. It delayed the required minimum distributions from 70.5 to 72. They're looking at expanding that a little bit further. We'll see what happens with that. But there were some downsides, some things that weren't in the original bill that we were pushing for that occurred. And some of those, Cynthia, are, for example, the elimination of the stretch IRA. So in the past, what people would do is they'd put away all this money tax deferred. We were talking about the difference between an IRA and a Roth.
Yeah.
Well, with an IRA, what people were doing is realizing, hey, I'll just not touch it, and when I die, I'll pass it to my kids, and they'll take it out over their lifetime. Well, with the Secure Act, what we got, unbeknownst to us, was basically forcing beneficiaries to have to take that benefit now over 10 years. For those people that have done a really good job of putting money away, they put away $500,000, $1 million, $2 million into these 401k plans. They figured, oh, it'll just become a pension plan or a retirement retirement plan for my kids. Well, that's no longer the case. Now they have to take it out over 10 years. So it forces them into a more accelerated payout, which we don't like, which makes it more important to make sure that, that you have a plan, and that big tax bill is coming. Just remember, are you trying to leave a huge tax bill to the kids? Because oftentimes that's what people do without their knowing.
So that could be truly a tax time bomb, if you will.
It's a mouthful, right?
Right, that's what I'm trying to say.
It is. It's a tax time bomb for sure.
Absolutely. So obviously, Stewart, if the Roth is such a better idea, if you will, why aren't a lot of advisors kind of pushing in that direction?
Well, I would say this, that, I think everybody realizes, especially when you start young, Roth is without a doubt a better choice in most cases. But most advisors don't get involved with clients oftentimes until they've acquired a certain amount of wealth. All wealth management firms like ours have, minimums that they deal with. But, once a client gets, a certain amount of assets saved up, they've got a few $100,000, $500,000, they start seeking advice from financial advisors. And so, think about this. If a financial advisor has $100 million under his management and he makes a percentage of those, right? Everybody realizes that their advisors make money on their investments. But if all of a sudden they say, hey, this $100 million that I manage, I'm going to tell them to go ahead and convert that to Roth and pay a 24% tax, they realize that most of that tax is going to be paid out of that underlying IRA or 401k. So they've just given themselves a 24% pay cut because now they're not managing $100 million. Now they're managing $76 million. So I don't like to question the motives too much of advisors and why they push people in different directions, which is why you always want to make sure, you're dealing with a fiduciary that has access, to tax planning. But, I really do think that it's in their self-interest. Also, if you have an IRA or a 401k, a lot of people never use their money because now that they know that when they take money out, it's going to make their Social Security more taxable, it's going to raise their tax brackets, etc. People end up dying with all this money in their accounts that that they put away during their lifetime. The worst thing happened, a year ago or so. I was in tax season, had this great man that came in, and he had done a great job of putting money away, into these retirement accounts. And when he came in, he was my last tax, delivery of the year, because we always hand deliver any tax returns we do. An advisor always sits with our, our financial clients that do taxes with our company. And I just said, man, congratulations. I'm proud of what you've accomplished. And he's 83 years old, and he's a Hungarian man, great man. And he just said, you know what, Stewart? What the hell was it for? My wife is dead. I didn't take those trips she ever wanted to take. I've got $3.5 million, and what for? What for? What good did it do? So I think a lot of times when people have all this money tax deferred, they're so afraid to use it because they don't want to pay the tax bill, right? Yeah. And when it comes to Roth, we alleviate those fees. If there's that trip you want to take, take it. If it makes sense, if you're not going to have to eat dog food down the road to do it, then, everybody's goal is different. Some people have goals to leave as much as they can to their kids. Others want to, what do they say, bounce the check on the way out to the undertaker? It's not for me to define your goals. It's for you to define them and for us to achieve them. And if you're just looking to stack up the money and press your friends with your balance sheet, I have no interest in dealing with you. If you're really looking to enjoy life, to be able to say, hey, we've worked our tails off for all this money all these years, and now we want to enjoy it, but know for certain, or with a high degree of certainty that we're not going to run out, then give us a call. We have that QR code on the screen there. You can reach us at apsitaxes.com. But all you have to do is reach out to us. If you give us a call at 833-652-7829, we'd be glad to take a look at your portfolio to show you if there's any options in there from a tax planning perspective. We can show you what kind of risks, but you have to take action today and give us a call. Once again, give us a call at 833-652-7829. Me or one of our advisors would be glad to meet with you at our Tempe office, our Scottsdale office, or our West Valley office. That QR code is really handy, really easy to use, so give it a try. It's like those menus at the restaurants that you discovered over, during the COVID period. But you have to take action today. look forward to hearing from you.
Stewart, thank you so much. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. We know you have a lot of questions for Stewart about how to plan your perfect retirement, perhaps tax questions as well. The number again is 833-652-7829. We have to take a very short commercial break, but don't go anywhere. When we come back, I'm going to talk to Stewart about inflation and how we should prepare. Take care.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes. It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is president and founder of Asset Preservation Tax and Retirement Services. Stewart, a wonderful show we're having today. And obviously, this next topic, I feel like I should tee up with a dun-dun-dun, inflation, because obviously we need to dive in and talk about that. It's affecting everything. So your thoughts on inflation, Stewart?
Well, it's a real thing. I think any talk of inflation being transitory is gone now. We know that it's not just here and going to leave. It's not some temporary thing. Right now we're seeing numbers between 6 and 8.5%. To bolster that opinion, the Federal Reserve Chairman Jerome Powell, obviously signaled that he'd be raising rates over the next year here 4 times, a quarter point or 25 basis points per quarter. So we're looking at 100 basis points or a 1% increase in rates here. We're going from the lowest interest rate environment in history to something higher, substantially. And so I think what that's doing is signaling, we've got to get this inflation, under control. And I think, people have seen or heard that they're going to get that 5.8% Social Security increase, and of course 5.8 doesn't keep up with the 7 or 8% increase, or the 50% increase in gas prices that they've seen here over the last year. I don't know whether to laugh or be upset when I see those Joe Biden stickers on the gas pumps there that say I did this, but it's I'm not trying to politically finger point here at all, but there's some issues here that are are concerning. Obviously, a lot of the ability to drill have been relieved and prevented, and so the cost of gas is going up. Production seems to be going down, but there's also unprecedented demand. So we really have to think it through.
Sure. Well, Stewart, I should ask you, what can people in the audience do about this right now?
Yeah, so, I can tell you this. We're seeing a lot of people that historically have kept tons of cash in their portfolio as a hedge, where, they're making, they've got 100, 200 grand, 300 grand, plus sitting in their checking, savings, money market accounts. And now what they're realizing that if we're seeing a 7% increase in inflation, well, guess what? Their money that they're making 0.5 point on is actually losing buying power by that same percentage point, right? So their money that they've spent their lifetime accumulating is becoming less and less valuable. They can buy less as things become, become more expensive. So I think a lot of them are really concerned. There are some things you can do about it to make sure that, you have a plan. And I think it's important that you do have that plan.
Well, Stewart, I'm hearing a lot about gold right now, a lot of advertisements surrounding gold. Let's talk a little bit about that.
Yeah, so, gold is an interesting play here. A lot of our portfolios insert gold ETFs into them from time to time. And what gold ETFs do is they're basically like an efficient, mutual fund. I'm way oversimplifying it, but it's basically a fund that owns physical gold. And I was at one of our money managers' places in San Francisco, and they're the biggest money manager in the world. They have some ETFs that they manage, and they have one of their ETFs that is a gold ETF. And I looked at the fund, and it only had 25 basis points of expense, 0.25% a year is what you pay. And I said to the guy, I said, well, how can they do that for 0.25? Because I'm always hearing about the super expensive nature of gold, about commissions. He's like, well, Stewart, this is what happens. Our depository where we keep this gold works like this. We have our pallets of gold, and then we have the depository pallets of gold. When people buy more ETFs, they literally pick up the physical brick of gold and move it to our pallet. And it's super inexpensive. And what we're seeing, Cynthia, is people that are watching these advertisements on TV and they say, oh, you need to buy gold or bullion or coins or whatever. And at the end of the day, you want to make sure it makes sense for you. I have clients that, their spouse passes away and they've got all this physical silver and gold. They don't know what to do. So where do they sell it? They end up selling it at pawn shops or some of these gold places that charge fees. Remember, everybody makes money when it comes to business. You just want to make sure it's fair. So I'll tell you a story. I had a client that has a gold IRA. So we've seen a lot of these kind of alternative, IRAs that not only have gold, but real estate, et cetera. Let's talk about the gold one. So when he bought it, they generally charge you, 15% or so to buy in. So they basically give you 15%, they charge you 15% above spot to buy the gold. Well, when you sell it, oftentimes they're charging you 15% below. So you have to make up 15 to 30% in expenses to get your money in and out. It's just super, super expensive. How are you gonna make up 30%, right? What kind of risk are you taking to do that? Well, it's commissions that you're paying to the advisors or to the salespeople that are selling you the gold. And I remember I had this great client. It's been my client for years. He'd loved this gold thing, and then he realized, you know what, gold's gone up tremendously. He put in 150 grand, and he wanted to take it out years later after gold had risen dramatically, and they were offering 130 grand, and he just didn't understand, and he was upset. And he came to me and he said, Stewart, they told me this was a safe investment, but how is it safe if you know you're going to lose your money?
That's true.
Right? Gold may be safe itself, but when you have to pay these tremendous commissions to a pawnbroker or to these IRA holders, it can get really, really expensive. Well, you know what? I had this plan, and he and I got together. I said, you know what I'm going to do? Is I'm going to call the guy myself. I'm going to call the salesman myself, let him know we're doing an expose on gold, on IRA gold, dealers here in Scottsdale in Arizona, and we're going to see what we can get done. So I let him know, hey, I'm Stewart Willis from the Asset Preservation Hour. My client here, has had an IRA forever, and the value on it is saying 165 grand, but they're offering him now 145 grand. I'm trying to understand the difference. He wants to liquidate. Can we get the 165? And the funniest thing is, he said to me, he's like, no, Stewart. He's like, we're not going to give him 165. He's an important client. We're going to give him 175. Is that okay for you? I was like, yeah, it's okay with me. And they gave it to him. But it took a guy with a TV show to have to call this place to get this higher value because they don't want any sort of scrutiny on the industry. It's a really tough industry. And I would just say, be careful, be wary.
Well, Stewart, this is the perfect time for us to reopen the phone lines. What do you think?
Absolutely. Well, you know, what we're offering the audience today is a complimentary portfolio review. You look at that little QR code on the screen there, you pull your smartphone up to that, or you go to apsitaxes.com. It'll take you to our website. Or you can give us a call at 833-652-7829. What we're offering today is a complimentary portfolio review. We'll take a look at all the risks, all the fees, all the expenses that you have inside your portfolio, just to give you a second opinion, let you know if you're doing the right thing or not. All you have to do is take action today. Give us a call.
Stewart, thank you so much. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. We have to take a very short commercial break, but don't go anywhere. When we come back, we're going to talk about tax preparation and tax planning. Stay tuned.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is the president of Asset Preservation Tax and Retirement Services. Stewart, as well as being your co-host, which I love, I've also been in real estate as a realtor for over 21 years now. And I'm hearing a lot of my clients say that they want to buy properties inside of their IRA. Is that a good idea?
Well, here's what I will say. I love real estate inside people's portfolios as a whole in terms of their estate. I think real estate is about as efficient as it gets. And here's why. Yes, Phoenix has had a tremendous run in growth. It looks like it's going to continue so long as interest rates don't, spike too heavily. I mean, the demand is tremendous. There's no houses right now. The supply chain is broken. So everybody knows, even to fix your baseboards, it's hard to find baseboards, right? There's just, the shelves are empty in terms of supply. But the efficient thing about generating wealth, building wealth during your lifetime with real estate, what makes it so efficient is the fact that you end up buying the real estate, you rent it out, so you have an income, hopefully positive cash flow. You're depreciating that property, so oftentimes the income you have coming in is basically offset by the depreciation, so you're not paying taxes on the income at the time. And then, over time, once it's fully depreciated, you do what's called a 1031 exchange, and then, you pass that to the next property and the next property. That's why everybody talks about the $750, tax return that Donald Trump had. It's because he's a 1031 king. He basically makes sure that, he depreciates his property, positive cash flow, takes loans against the properties, and then he passes this to his kids with a step up in basis. So there's never a capital gain. Well, and by the way, that step up in basis may be going away. But now that we see some of these local companies that are doing, what they call self-directed IRAs, and they have these rental properties inside it, well, here's what I'll say. Does it make sense, to your original question, Cynthia, does it make sense to have a self-directed IRA with real estate? Sometimes. Now, if you're doing flips, for example, and you're going to buy and sell within a year, and you're young, you're nowhere near, your retirement age, yeah, I think it's, an efficient way to do it, so long as the market continues to grow. But what you miss out on is that if it's inside an IRA wrapper, you can no longer depreciate it, right? Because remember, any dollar you take out of your IRA is taxed at ordinary income. They don't look at the depreciation on that. So you lose a lot of the huge tax efficiency of owning real estate when you're in these self-directed IRAs. And I think it's really important and really eye-opening to a lot of these people that have these holdings where they really love the real estate part, but they're looking at how to unwind this problem. And I would just say, give us a call. It's a super important thing to get a second opinion on it. We've also seen, that a lot of these self-directed IRAs, it's all self-reported. So you self-report values, they look at your bank account values. It's a big pain in the rear. When it comes time to required minimum distributions, how do you assess the required minimum distributions? And what if there's not enough liquidity inside the house itself? Well, you're going to have to sell part of the house, or is the income going to pay for your RMD? What are you going to have to do? And there's technical ways around it, but it's a complete nightmare. Huge potential penalties if you mess it up. I had a client that didn't take RMDs because they thought they didn't have to inside a property. It was at a self-directed IRA. They didn't take RMDs for 5 years.
Wow.
It's a 50% penalty per year for every year you skip.
Wow.
So does it make sense? Does it not? I would just say this, Cynthia, there's a lot of downside to it, especially as you get older.
Yeah.
I don't hate it as a flipping model, if you're younger, though.
Okay. Well, Stewart, thank you so much. Great response to that question. Really quickly, I do want to touch on the difference between tax preparation and tax planning. Can we talk about that?
Sure. So, we have a tax preparation office at Asset Preservation. It's one of the key reasons people come, because they like to do everything in one place with us. And we've started to see a couple people, a couple advisories try to copy it. They're not there yet, but they're trying. But tax preparation is all about filing taxes. It's what you do, before April 15th to get your tax return, right? You're basically sitting there with a tax preparer that's working 12, 15-hour days. They're grinding it out, trying to get as much work done as possible. But that's just the preparation of your taxes. Tax planning is generally what we do year-round and focus very strongly in November and December. That's where we start looking at Roth conversions, tax harvesting your capital gains, realizing, other gains inside IRAs, etc. We save all that for the end of the year, the actual activity of it. But tax preparation and tax planning are totally different. I would never seek tax planning advice during the tax season, because those guys are working hard, they're working their tails off, but they're zombies at that time of the year.
Sure. Well, that makes perfect sense. Well, Stewart, we only have a minute left of the show this week. Any final words of wisdom to give to the viewers at home?
Yeah, you know what? We've touched on a lot of things on this show here, and if any one of those things, make you wonder, hey, am I doing the right thing? Am I doing the wrong thing? You know what? All you have to do is take action and give us a call. We have that very simple QR code there on the screen. You can give us a call at 833-652-7829 or go to our website at apsitaxes.com. Listen, I'm the same person in person that I am on TV. If you don't like me on TV, you're not going to like me in person, so don't call. But if you want help, we're there for you. But you have to take action.
Stewart, thank you so much. To the viewers at home, thank you for spending time with us. That number is 833-652-7829. Be safe, be happy, be blessed. We'll see you back 1 week from today.